Okay, so this is just a video on how I react to the market once price approach or gets to my areas of interest, okay, or my point of interest, okay. Now, this point of interest that I look out for, if you've been following my videos or my trade callouts, you will notice that I do have a point of interest highlighted in the yellow box, okay. So this point of interest, most of the times, are order blocks, okay, or some of them are base areas, so they can be demand areas or supply zone. Okay, so once price gets into my areas, my point of interest, what I do is that I look out for reversal patterns. For instance, we have the double top pattern. Okay, and once this pattern is formed and confirmed, then I take my sell trade, and then uh, that is basically how I trade. I react to the market once price gets into my point of interest. So as you've already known, I focus more on GBP USD. Okay, so I'm going to be sharing with you guys the two structures that I look out for, the two reversal structures or patterns that I look out for on GBP USD once price gets into my point of interest. And the first structure that I look out for, depending on the direction of the market, can be the double top or the double bottom pattern. Okay, right. So this is just an example of a double top pattern. Okay, and then the inverse of this is referred to as the double bottom pattern. Okay, now how do I trade this first structure? Okay, the double bottom pattern. Now I made a video earlier, sometimes a couple of months back, that the one of the wrong place to sell, most people do is that they wait for price to form. A double top or bottom pattern has two legs. Okay, so you see the first top, okay, and then price retraces a little bit and then go back to the top and then drop from there. Okay, so most traders sell from these necklines, or rather they wait for price to close below this neckline before they take their sell trade. Now, from experience, I've seen that most times when you sell, sometimes once price forms this top, immediately the next candle that forms, breaks this structure, okay, or the neckline, and then closes somewhere around this area. If you decide to sell around this place, the structure has already been formed. Price has gone way below the neckline. So if you sell at this area, you might see price correcting a little bit, thereby liquidating your account or hitting your stop loss. Okay, so that's one of the reasons why I don't sell from the neckline. Okay, that is one of the reasons. Sometimes when you sell from this neckline, the market makers who they just want to grab liquidity, or most likely price is just correcting. Price will correct, might correct up to these tops. Okay, so if you have your stop loss placed somewhere around here, price can still the market price can still go back, take out your stop loss, and then crash down, follow your earlier predetermined direction. Okay, so that is one of the reasons why I don't sell from the neckline. Okay, so is this one of the wrong place to sell based on this pattern? Okay, so what I do is that I wait for, most times this pattern has two legs. Okay, now most of the time these legs are characterized by weak rejections. Okay, so you will see price weaken at this area, you will see weak rejections. Okay, so what I do is that I wait for price to come back. Once price drops from after price gets into my point of interest, the first leg is formed, you will see several weak rejections. Once price weaks out at this area, I wait for price to drop down and then return back to this area where it once wicked. Okay, so let me take this off a little bit. Okay, so once price returns back to this area, once where it once wicked out, I'm coming. Okay, so once price returns back to this area, one where it once wicked out, I take my first risk at this area. Okay, so this is actually where I'm looking at. So once I see on the 15 minutes time frame, once price wicks out, like twice, give me two candlestick weak rejections at this area, I take my first risk. Okay, I take my first risk. Most times I will break this pattern down very well on the number two pattern. Okay, but this is how I trade. For those people that don't really that or might not really have enough time to understand this number two, but it is quite easy. Okay, so but I will break this down very well for you to understand it. Okay, but for now, just take it as at this surface level. This is what I do most times. So price returns back to this area where it once wicked out and start wicking it all over again. Okay, I take my first trade, and then my stop loss most times 10 to 15 pips depending, and then we hold the trade for as long as, or depending on our take profit. Okay, so this is the first way. So whatever I've explained for this double top is applicable to the double bottom. Okay, it's just an inverse of what I've already explained. So this is actually how I take my trade. I trade based on this first structure or pattern. Okay, you can see the difference. The risk to reward ratio mostly on trading this way is it's a little bit higher. Okay, comparing to when you sell from this from the neckline. Okay, if you sell from the neckline, the best place your stop loss should be is somewhere around there. Okay, as you can see, you have the stop loss is huge. Okay, and your risk reward ratio is less than 2.0, which is very poor. Okay, so uh that is one of the reasons why I don't trade from the neckline. It is wrong. Please, if you are trading this way, stop trading from the neck, stop selling or buying from the necklines. It is wrong. Okay, your risk will be unnecessarily high. Okay, so that is just now. Imagine when if price decides to go back and hit your stop loss, you are going to be losing 31 pips, which is which is a huge amount of pips to lose. Okay, on your trade. So that is how I trade based on this first structure or patterns that I look out for. Okay, so now let me go down to the second structure that I look out for, and then you understand better why I sell from these tops and not from the neckline. Okay, so let's take this off. Okay, okay, so let's take all this off. Let's take this off. Let's take this off. Okay, so as usual, we have our point of interest. Okay, and the point of interest can be on the 15 minutes time frame, can be on the 1 hour time frame, can be on the 4 hours time frame. Okay, so but once price, so what I'm waiting for is for price to appreciate into this point of interest. Okay, now considering the fact that I trade GBP alone, most of the time I trade GBP, I know that once price gets into my point of interest, the first thing I do is I go down to the 15 minutes time frame. Okay, now I know that most of the time, about 70 to 80% of the time, once price gets into my point of interest, the next structure that GBP forms is the what they call it, the double top pattern. That is number one. This number one pattern that I look out for, the double top pattern or the double bottom pattern, depending on the direction of the market. Okay, so now in order to to refine this pattern, that is why I added this number two structure. In order to refine number one pattern and also to reduce, as you can see, our stop loss using the number one structure is usually somewhere around 10, 15, 20 pips. Okay, now in order to further refine the way you take your trades based on the number one structure, I now what I do is that once price gets into this point of interest, I go down to the 1 minute time frame. Okay, on the 1 minute time frame. Now on the 1 minute time frame, you see the legs. Okay, look, let's take it this way. Okay, now on the 15 minutes time, still on the 15 minutes time frame, once price gets into this point of interest, price will start weakening out. Okay, forming. Let me take this off. Let me take this off. Okay, so once price gets on the 15 minutes time frame, once price gets to the point of interest, price will start weakening out at this point. Okay, to give us the first leg. To give us the first leg. Oh, why did this go off? Okay, so price will start weakening out at some point to give us the first leg of the double top pattern. Okay, as you can see, we have just a single leg. The leg is the double top pattern is not yet complete. Okay, so once I see this on the 15 minutes time frame, I go down to the 1 minute time frame. Okay, I go down to the 1 minute TF. Okay, now on the 1 minute time frame, this is what you will see on just this area. This is what you see on the 1 minute time frame. You start saying price creating the high low, a bullish structure, higher high, lower low, higher high, sorry, higher low, and and so on and so forth. Okay, so this is what you have on the 1 minute time frame. This is what you see on the 1 minute time frame. Now, this correction or little drop that formed this first leg on the 1 minute time frame, you also see it on the on the 15 minute time frame. You also see it on the 1 minute time frame as this. Okay, so at this point, you see that price broke a structure at this area. Okay, you see, let me take this changes to black. Sorry. Okay, so at this area, you notice that price gave us a break of structure, BOS. Okay, sorry. Okay, so we had a break of structure at this area. Okay, so now, Okay, so we have the high, the low, the high. So you see, it's similar to Quasimodo structure. We had this high, the low, the higher high, and then we had a price break this low, this low, this low, creating a lower low at this area. Okay, now most of the time, before a structure is broken, price forms maybe an order block, a base area, or a supply area that will lead to the break of this structure. So what you see immediately price breaks this structure is price going back on the 15 minutes time frame. If you are watching on the 15 minutes time frame, you will be seeing that price is going back to create a second leg. Okay, but on the 1 minute time frame, what price is actually doing is price is going back to test the supply area, okay, or this high, the QM level, or the supply area or the base area that led to the break of this structure. Okay, so once price returns back and tests that base area, the next thing you see is a price crashes down. Okay, so this let me get something here. So this might just be a supply. So we have another point of interest on the 15 minutes time frame, or sorry, on the 1 minute time frame. Okay, so this might be a supply, okay, or a base area, or this high that price from this QM level. Okay, so once price returns back into this QM level, this is actually where we take our trade, and this is the same area where we took the trade on the 15 minutes time frame. But in this case, it is more clear. I'm not giving you the reason. I'm not explaining why we are taking this trade at the top and not at the neckline. Okay, so at this point, once price gets into this point of interest on the 1 minute time frame, that is actually when I take my trades. Okay, so you can see if you take your trades from these areas of interest, your stop loss will be very, very, very minimal, very small. Okay, your stop loss will be placed slightly above the high of the zone. Okay, and then you hold for as long as, so this area is just the neckline. Okay, so we and price can still drop down further to somewhere around here. So as you can see, our risk reward ratio is usually very high trading like this, instead of selling from the neckline, or instead of selling from the neckline or selling from the 15 minutes time frame. And if you go down to the 1 minute time frame, you find that you will have a small stop loss, which is somewhere around 2 to 5 pips stop loss, and then you have the huge around, you see, over 100 pips as a take profit, which is around, this is around 1 is to 18, or 1 is to 19, approximately 1 is to 19 risk reward ratio. So this is actually how I take my trades on GBP USD. I strongly believe that you must have learned a thing or two from this. Thank you guys for your time. Please do share, like, subscribe. If you like this kind of content that I put out, please like, share, and subscribe. Thank you very much for your time. I truly appreciate it. Thank you guys.